If you own an S-Corp, there's a mistake that can cost you $30,000, $50,000, or more. And most business owners don't even realize they're making it, because nothing looks wrong. Your business is running, your taxes are being filed, and on the surface, everything feels under control. But the issue isn't what you can see. It's what's building quietly in the background until one day, it shows up all at once. Year 1, you feel smart. You set everything up, you start seeing savings, and it feels like you made the right move. Year 2, you feel confident. The structure is working, you're doing the same thing again, and nothing seems off. Year 3, you think you optimized everything. At this point, you're not questioning it anymore. You trust the system. Then one day, IRS notice. Everything you thought was tax savings suddenly gets reevaluated. And instead of savings, it turns into back taxes, penalties, and interest. What looked like a benefit becomes a liability. If reviewed by the IRS, prior treatment may be reevaluated based on the facts and reporting consistency. If you have an S-Corp right now, there's a possibility you may already be on this path without realizing it. Not because you did something obviously wrong, but because these issues don't start with a clear signal. They build quietly, through small decisions, repeated over time. And by the time they become visible, they've already been there for a while.
Wait, seriously?
Yes. Let's be clear, an S-corporation can reduce self-employment tax exposure, but it does not automatically optimize your overall tax outcome. Setting it up doesn't create the benefit. Using it correctly does. Because the S-Corp structure comes with rules, and those rules have to be followed consistently. Not once, not at setup, but every year. When those rules are applied properly, the structure can work. But when they're misunderstood or only partially followed, the expected savings don't hold. Let's follow one example, a business owner who believed he had optimized everything. His structure was in place, his filings were consistent, and each decision he made seemed reasonable at the time. But over time, he made 7 small decisions. None of them felt risky. None of them felt incorrect. Each one made sense on its own. But together, they created a pattern that slowly moved him out of compliance. First, he kept his salary low. From his perspective, it made sense. He thought, I'm saving on payroll taxes. And on the surface, that's what it looks like. Less salary, less payroll tax. But the IRS doesn't evaluate it that way. It doesn't ask what you prefer to pay yourself. It evaluates compensation using a facts and circumstances analysis, including duties performed, time devoted, business profitability, and comparable data. If compensation is determined to be unreasonably low, the IRS may reclassify a portion of distributions as wages. If the salary is too low, the IRS may reclassify a portion of your distributions as wages. And when that happens, the payroll taxes you thought you avoided come back. Second, he took most of his income as distributions. From his perspective, this felt efficient. Less salary, more distributions, lower payroll taxes. But the IRS doesn't look at how efficient it feels. It looks at whether the split can be justified. This determination is based on facts and circumstances, not a fixed percentage. If most of the income is coming from your work, then most of it should reflect compensation. If that allocation is not considered reasonable based on the facts, the IRS may recharacterize a portion of distributions as wages. When that balance is off, the IRS may treat those distributions as wages. And once that happens, the taxes you thought you avoided are recalculated. Third, he treated certain benefits as tax-free. Things like health insurance, reimbursements, and other company-paid expenses, he assumed they wouldn't be taxed. But for shareholders who own more than 2%, that's not how the rules apply. The IRS doesn't treat you the same as a regular employee. Those benefits are still included in income, just reported in a different way. For example, certain benefits may be included in W-2 Box 1 income, may not be subject to FICA if properly structured, may be deductible on the shareholder's individual return under Section 162L, if eligibility requirements are met. So while it may not show up as traditional wages, it's not excluded from tax. And if it's handled incorrectly, it can create reporting issues and adjustments later. Fourth, he didn't make the PTE election. It wasn't something he actively avoided. It was something he never evaluated. Each year, the business generated income, and that income flowed through to his personal return. But without the election, the state taxes were paid at the individual level, without access to the potential entity-level treatment. So year after year, he may have paid more in state tax than necessary, depending on his specific situation and state rules. PT elections vary by state and are not always beneficial in every case. Not because of a mistaken calculation, but because of a missed election. And since this is a yearly decision, missing it once means missing the opportunity for that entire tax year. Fifth, his S-Corp election wasn't properly filed. On the surface, everything looked like an S-Corp. The structure was there, the operations followed the model, and the strategy assumed S-Corp treatment. But without a valid election, the IRS does not recognize the entity as an S-corporation unless late election relief is properly obtained, which means all of the planning built around it doesn't apply. In some cases, late election relief may be available under IRS procedures, depending on the facts. The tax treatment changes, and the expected benefits don't exist. So even though the intention was correct, the foundation was never established. Sixth, he focused on saving taxes now, but didn't plan for exit. He used strategies like bonus depreciation and more aggressive deductions to reduce income in the short term. And initially, it worked. The tax bill went down, the savings looked real, and the strategy felt effective. But the structure of those savings wasn't permanent. Because some deductions don't eliminate tax, they defer it. And when the business was sold, much of the prior tax benefit may be recaptured or recognized. The deductions that reduced tax earlier were now reversed through recapture. And if the entity had been converted from a C corporation, built-in gains rules applied, which means gains that existed before the conversion were still subject to tax when the business was sold. So what looked like savings was actually timing, and the full impact only became visible at exit. Seventh, he assumed all losses were deductible. The logic seemed straightforward. If the business shows a loss, it should reduce taxable income. But at higher income levels, additional limits apply. These may include basis limitations under Section 1366, at-risk rules under Section 465, passive activity limitations under Section 469, and excess business loss limitations under Section 461L. So even if the loss is real, and even if it's calculated correctly, that doesn't mean it can be fully used in the current year. Some of it may be restricted, some of it may be deferred, and the actual impact on your tax bill can be much smaller than expected. None of these mistakes felt big. Each one made sense at the time. Each one looked like a small decision, a minor adjustment, a reasonable choice. But over time, they didn't stay isolated. They started to stack. And together, they created a pattern in how the structure was being used. A pattern that gradually moved further away from how the IRS expects it to operate. And that's when everything surfaces. Not gradually, but all at once. The IRS reviews the structure, looks at how income was classified, and starts reevaluating the decisions that were made over time. What once looked acceptable is now reclassified. And once that happens, the consequences follow. Back taxes, penalties, interest. Not because of one decision, but because of the pattern those decisions created. Most people don't realize they're doing this wrong because nothing feels wrong while it's happening. The structure is in place, the business is running, and the filings continue as usual. It only becomes clear if the IRS reviews the return and starts asking questions. And by that point, the issue is no longer about fixing it early. It's about dealing with what has already accumulated. So the question is not, do you have an S-Corp? Because having the structure doesn't determine the outcome. The real question is, are you using it correctly? Are the decisions aligned with how the IRS evaluates compensation, distributions, and ownership? Because the structure itself doesn't create the benefit, how it's applied does. If your salary is low and your distributions are high, if you haven't revisited your structure since the business grew, if decisions were made once and never reviewed again, then this may apply to your situation depending on your facts. Not because something obvious went wrong, but because the structure no longer reflects how the business actually operates. And the longer this continues, the more expensive it becomes. Not all at once, but gradually as each year builds on the last. Because unresolved issues don't stay the same, they compound. And when they surface all at once. S-Corp savings are not automatic. Every decision inside the structure comes with trade-offs, and each one carries its own level of risk. And in many cases, what looks like savings on the surface is actually overpayment or exposure somewhere else. Because in the end, it's not just the structure that determines your taxes, it's the details that determine your risk. If you're not sure whether your S-Corp is set up correctly, or whether it's actually working the way you think it is, comment S-Corp. And I'll help you check how your structure is functioning today. Or explore the course below, where I walk through how this is applied correctly, step by step, so the structure aligns with how the IRS evaluates it.